Okay, and I think we are live. So I just want to say hi, everyone. In case I haven't appeared on your screen before, my name is Alexandria Banta, and today I'm filling in for Juliana Cardona Mejia. We happen to be live with Ann Connor of Connor Business Resources, and she is joining us today virtually from New Hampshire. Ann, would you like to introduce yourself and take it away?
Sure. I'm a business coach, and among other things, out of New Hampshire. And today we're going to talk about financials. So I'm just going to start, and I'll tell you a little bit about myself as we go through. But the first thing I want to start with is talking about the money that flows through your business, that it just runs through your fingers. And as soon as you add cash into your business, it's leaking out somewhere. So how do you make sure you have enough cash to actually keep running your business? So creating a workable budget is the answer. And I know you're saying, I cannot wait. It's so much fun. But budgets are essential to financial success, and that's what we're going to talk about today. So how to keep more money in your business before it flows down the drain. But so let me give you a little idea of who I am. This is me and my little boy. He's 7. I was a retail buyer for Sam's Club for many, many years. I bought cookies, crackers, and snacks, actually. So I was a food buyer. I used to eat for a living, I used to say. My budget was $600 million, and that's how I became fascinated by numbers, of what numbers really meant when you were running a business. From Sam's Club, I started a product development company, and we imported Belgian chocolates and dog food. We were very eclectic. We had dog food coming out of Canada. We had treat jars coming out of China, and we had Belgian chocolates coming out of Belgium. So we were really eclectic on what we were doing. I was living in Oklahoma at the time, and I moved back to New England because I'm from Massachusetts. So I moved to New Hampshire, and I purchased a coaching franchise called AvaCoach, which was brand new in this area. And we were able to really build it. We spent 10 years building that business. And we won many, many accolades and many awards by being the best franchisee and the best coaches in the area. I sold the practice when Joey came into my life, and I decided to create Connor Business Resources, which is an online education and resource system for those businesses that have those burning questions at midnight and they just don't know where to go, and you're tired of Googling. This particular site has all sorts of resources and tools, which I'll tell you a little bit more in a minute. I'm also the chief operating officer for a property management and construction company. So I have a very eclectic background, and I handle financials on a variety of different industries and different businesses. But to give you an idea of what my company is all about, is we're an online interactive education system that offers video teaching modules on all areas of business that organizations need to survive and thrive. So business planning, strategic planning, finance, marketing and sales, team development, customer services, human resources management, and leadership. These are the 10 areas that every entrepreneur should have addressed in their business, whether they are a startup or a mature company that's been in business for years. We have videos that are 30 minutes or less. We have tools and templates. So you've got to figure out how to do something for your business. We have the resources for you, along with a collaborative of coaches from many, many different industries. So that's who I am. So let's talk about financials, which is kind of my favorite thing in the world to talk about. So money is like water, and it can slowly leak out of your business in nickels and dimes and turn into a significant financial loss. Without a budget, money can disappear from your business in seconds. And I'm sure you all have felt that. One day you feel really good about the cash in your business. The next day you're wondering where that cash went. So how can you prevent this from happening to your business? Create a financial budget. I can't stress how important a financial budget is in your business, whether you're a startup, you've been in business 5 years, or you've been in business 25 years. I talked about being a corporate buyer for Sam's Club, and I had a budget of $600 million. But see, I said budget. I had a budget. I had to come up with my expenses and my income and my gross profit, cost of goods, all that kind of stuff. and I worked with one of the biggest companies in the world. So it does not matter what size company you are, a financial budget is really necessary for the financial health of your company. Financials are the cornerstone of your business, and without them, you don't have a business. So planning your numbers and understanding how they flow through your business is critical to your success. I think of financials as the foundation of your business, just like the foundation of your house. Without a strong foundation, your house does not stand. Without a strong financial foundation with a strong cash flow, your business could turn into a house of cards and fall apart incredibly quickly, even before you realize that there's an issue rather. So I'm going to overwhelm you for just a minute and just show you what a budget might look like for you. Now we're going to go through this budget line by line, so you really have an understanding of what areas that you need to work on and what you do with those areas in your business. We're going to break it down in bite-sized chunks, and by the end of our time together, you're going to understand how that money flows through your business and why a financial budget is incredibly important. So what I like to do is start off with a break-even plan. And what a break-even plan is it tells you the least amount of money, the least amount of profit that you have to bring into your business in order to break even, meaning in order to hit a zero net income. So in this example, your sales are $15,000, your cost of goods is $5,000, your gross profit is $10,000, and your expenses are $10,000. That's a zero net. It tells you that in order for you just to pay things and just to stay whole, these are what your numbers need to look like. And if you do that for your business, obviously everyone's businesses will look differently. But if you do that for your business, then you'll have an understanding of exactly what the numbers should look like. So any questions so far? I'll check in with people to make sure that I'm answering your questions as we go along.
My apologies, I was muted. It looks like we actually do have a question from an audience member on Facebook. And this entrepreneur asks, how do you know when you need to adjust your budget? Or how do you know when you are breaking even considering the cost of your time? I'm sure we'll go a little bit more into those things as we go on.
Yeah, we will address that. The cost of your time is one of the hardest questions to answer because we all have different values of us. A lot of times what I say as owners, it's very easy to work for free, which you do not want to do. And it's very difficult to evaluate what your worth is and stay competitive. Because I've had business owners saying, oh, I'm worth $50 an hour, depending on what they do. But now they're not competitive with their price point. So it's a really difficult question. And as I get into cost of goods, I'll get more into that one. But that's a great question. In terms of the break even scenario, I'll also talk a little bit further about that as we get into our expenses and our net in that scenario there. But that's a good question. What I like to do is for my clients, when we're figuring out how to start a budget, because really it's where do you start? If you have history, it's a lot easier to start than if you're new to the game and you really don't have a lot of history behind you. I like to start with just what I call as a revenue overview template. And what it is, so I'm going to tell you two things right now. One, if you're a startup, you're going to play a lot of guessing games. I tell people, let's go to Vegas because we're just going to figure out by guessing and by validating what we believe our sales should be. And notice I said the word validate. We're not going to just throw numbers up there that make us feel good. We're going to actually validate those numbers to make sure that we have the capacity to actually hit them. If you have been in business for a few years and you've been hopefully tracking your numbers, you have history. So you can go back and you can see what you did in 2019 in January, or you can see what you did in 2018 in February and have an idea of how you're trending and how you're growing. The one thing about a budget that it's difficult is it's not one of those things where you can just teach it once and everyone go, oh, great, let me go off and do it. It's very different for every business. And it's one of those hands-on things that you really have to work on and come up with scenarios for your particular industry and your particular business. So what I'm going to do is give you an overview, but as you're working it, you will find different ways where you can come up with your own kind of numbers. But if you start off with something like this, the revenue overview template, and you're putting in your numbers, what I like to do is put in categories or items. If you're selling, let's say you're in retail, and you've got your categories, you've got your soft goods, and you've got your hard goods, and you've got your food. Or if you're manufacturing T-shirts, and you've got your long sleeve and your short sleeve and your hoodies. Or if you're a consultant and you do face-to-face coaching, you do classes, you do public speaking. Those are all categories that have different profitabilities and they have different sales. What you really want to understand is, what do those mean to your business overall? And let me show you why that's really important. It's really important because the percentage of sales will determine your profitability. So for example, we have one item here, item 5, that does 29%, bestseller. Item 2 that does 12%. That's your worst seller. And you're going to have best sellers, you're going to have worst sellers. But if we look over here at the profitability, you see that item 5 is only 25%. And item 2 is a 60% margin. So you make a whole lot more money on item 2 than you do on item 5. So as you're working through your income, you have to also be thinking about your profitability. So you may say, you know what, item 5 is a great item. I want to continue to sell that. And that's great. So let's work on the cost of goods. Let's work on the profitability. Item 2, you may say, you know what, that's a great item. I'm making so much money on it. Let's drive that instead. So now your marketing is going to change. You'll find that everything in your business touches your financials. So once you come up with your sales, your sales numbers, you've got to create that marketing plan that's going to drive those sales numbers. So it all ties together. So right now with this scenario, your business is at a 41% margin for your entire business. Now, if I was to switch and make this 25% margin and this a 60% margin and keep my sales the same, this would turn into another $2,000 or 44% margin. So just by tweaking your sales or tweaking your margins, which I will get into more in a minute, you can really increase your profitability. But that's why it's important to understand how your sales break down in terms of percentages overall before you even start looking at your monthly.
Thanks so much for this demonstration. We have a couple of questions, if now is a good time.
Sure.
So watching on Facebook, Sharonor is asking, is this monthly, quarterly, or annual?
So this particular form that I'm showing you, I would do it annually. I would start annually and then break down to monthly.
Right, right. I can see that kind of from the description that you have up there. That makes a lot of sense. The other questions we have are, when do you know it's time to eliminate a product from your catalog? Is there a specific percentage that might be an indicator?
There's a couple ways I would look at that. One, I would definitely look at the profitability. And if for some reason it's a really low profitability and there's nothing that you can possibly do to increase it, and if the sales are low as well, obviously that would be a perfect one to get rid of. You want to see how it trends though. So if you're in your first year or even your first 3 years, I would hesitate before I would start doing a lot of discontinuing of products unless you have a massive amount of items, because you just don't know what your trends are going to be. 3 years is still early to really set trends in terms of how much marketing have you done, how much support have you given it, is it a like item? I mean, there's a lot of different conversations you should have. But if your sales are low and your profitability is low and you've had it for a few years, then I would definitely check that baby off to possibly take out of your assortment. But if it's an item that you have high sales and low margin, let's work on that margin. See, can we get that up and get that to be a better profit area? Or on the converse side, if it's a high margin and low sales, what can we do to get those sales up? So that would be a conversation I think I would say to have with your team or with yourself, depending on what your company looks like, and really think through and validate the item to see how important it is into your portfolio.
Definitely, definitely. So this one is interesting. This person asks, is it a good thing to have sales percentages distributed evenly amongst your portfolio, or is it okay to have a product with the majority of sales?
I would find it to be odd to have it streamlined. I don't think I've ever seen a sales portfolio where everything is the same. So it is going to be, I think, just the nature of the business. I mean, I used to sell, one of my items was potato chips. I'd have three different brands of potato chips, and they weren't the same. They were all fluctuating. Lay's number 1, Utz number 3, depending on the region I'm in. So, I mean, I don't think that there's anything in the world that sells the same in a portfolio. If you have one item that is controlling you, that makes me a little nervous. I like to diversify a little. It's just like your financial portfolio for your IRA. You like diversification, because what happens if something happens to that one item? You have to change vendors or something, and the price goes way up. They stop making a component of that particular item. Something changes in that, and all of a sudden it just kills your business. So I would caution on that. I would try to get items that they won't be the same, but they're equally as important in some way, and one does not overshadow it all. Now, in the beginning, that's hard. So in the beginning, you probably will have one thing that overshadows everything, but I would suggest or recommend that as you create your portfolio, you find other items that are equally as important to your company.
Definitely. Thank you so much for the explanation.
Okay. Anything else? Good.
Sorry. That's it for right now, but I'm sure we'll have plenty more.
All right, cool. So once you've figured out what you want your yearly sales to be, then it's a little easier to break it down by month. Because if you start here and try to do yearly, I've never found that works really well. You just end up with a huge number at the end because you think every month is going to be perfect, which we know it's not. So here's how I do my monthlies. Now, if you have history, so helpful, because you can look back and go, okay, for this particular income stream, and you'll find out as we go through this, and I apologize, I am incredibly anal. So I do things down to the micro detail when I'm doing a budget, just because in my mind, every penny counts. But when you're looking at this, so income stream number 1, we'll just look at this guy right now. What you want to do is if you have history, you want to determine what percentage of my sales on a monthly basis was income stream number 1. And we could find out that January was 10% of your sales, February was 8%, March was 11%, etc., all through the year. And that's kind of how you figure out your month if you have history. You'll take your $53,000 and determine, okay, January was 10% of that. So I'm going to take 10% of that $53,000 and stick it in January. February was 8% of that. I'm going to put that, and there you go. You've got your year, and you've got it based on the trend of your sales from the following year. As you grow and mature as a company, you will find that your trends on months kind of remain the same. January may be 10% this year. It may go to 11% next year or 12%. It may drop to 8%, but they stay within the margin of error. They stay within kind of the same area. as you mature. In the beginning, it's a roller coaster. Who knows what's going to happen. So in the beginning of your world, when you don't have a lot of history, it is some guessing. So you put your numbers in as comfortably as you can. And then what I would say to you is you look at that income stream and say to yourself, how much of that particular widget do I have to sell in order to make that number? So for example, let's say you sell hand cream, hand lotions, and you have a category hand lotions and your average retail is $9.99. You want to look and say, okay, for me to do $4,000 at $9.99, how many items within this category do I have to sell? And then that number needs to feel good to you. And how am I going to market it? And how am I going, that becomes your marketing plan. But it has to feel good. So if that number came out and said, I have to sell 1,000 items in order to make that 4,000, that's probably not comfortable for you. That's probably a number that you'll say to yourself, I don't think I can do that. But if it comes out and it's like, I need to sell 250 in order to hit that number, that feels a lot better. So now I feel good about that number in that particular cell. And that's how you do all of your income streams in all of your months. It can be really overwhelming and it can be a long project, but I can guarantee you when you're done, you will totally, totally understand what these businesses mean to you, what you need to do to be successful on a month, and you'll have a monthly plan in terms of growing that business. Does that make sense? Does anybody have any questions there? Okay, then I will go on. I'm going to go on to the cost of goods, which is the most difficult section of your entire budget. And I'm going to kind of give you a highlight for it because it's a class unto itself. And when we talk about it today, we won't be talking about every version of cost of goods because there's so many ways of costing out products depending on your industry and depending on what you're doing. But basically what's in the cost of goods line is the products, the materials, the labor, what goes into making that product. So I'm going to give you an example and we'll come back to this, but I just want to give you an example of possibly how you could cost something out. This is an example of selling t-shirts, being a graphic designer and printing front and back t-shirts. The way you break this up, now I'm not sure who's on the call in terms of, are you consultants? Are you retail? Do you manufacture your products? Because there's a different tactic for each one of those. I'm just going to look at a manufacturing type scenario at this particular moment. So let's say you produce t-shirts. You want to start off with understanding the labor of what you're producing. And we're producing, in this particular example, we're producing an order for a customer. So we understand that we need 33 hours to produce 1,000 t-shirts. And my employees are going to work on this particular project from design to shipping. So it's the entire project. It's going to cost my company $400 in labor. That's your cost of goods. Now, if these individuals were also during the day receiving inventory, cleaning a press, mopping the floor, that part of their payroll would not go into the cost of goods. That part of their labor would go into your W-2 on your expense line. So there's a difference, and you've got to really manage that difference. The labor that goes into the cost of goods is only the labor that touches the product that you're producing. So we know that it's going to cost us $400 in labor. The equipment side. Now, this is something that I would highly recommend that everyone has an accountant and you meet with your accountant at least once a year, if not more. And this is a definite accounting, talk to your accountant in terms of coming up with these numbers if you are a manufacturer. We want to keep in mind when you're manufacturers, you've got you've got equipment that will break and need to be repaired. You'll have equipment that will need to be replaced at some point in time. They have shelf lives like everything. You want to understand not only how much it really costs you in terms of the time you have to replace, what it costs you to use it, but you also want to understand the electricity and all the other utilities type things that may go into running that particular piece of equipment. And you want to have it in here because you want to have a fund, a capital expenditure fund that you're putting money into. So when that press or that dryer or that blender or whatever it is that you have needs to be replaced, you're not having a meltdown because you've got no funds to replace it, because you've planned for that. And you plan for that by putting some of that money into your cost of goods. So in this example, for us to do this particular order, it's going to cost us $160 to run that equipment. Do you have a question so far?
I do. We have an interesting question from Sue. And she says, what if there is no physical product? For example, we have a course that is purchased and done fully online, and there are no physical products to produce. I think that's interesting.
Mm-hmm. So that gets it. When you're a consultant and you do things like that, it's so difficult to figure out your cost of goods. So your cost of goods in that term is your time, your intellect. You know, what we as consultants, we don't have t-shirts we sell our intellect. And that is what our brand is, right? Our brand is us. Our brand is what we produce. So you had your class online that it took you time to produce. It took you time to create. It took you time to put it all together. Now, you have to be very careful because it could have taken you 300 hours to put it together. And if you put your time into that, you just have this course that you have to go to Harvard to be able to afford it. So you have to be very careful on how you put your hours into it. But there's a lot of intellectual properties there. You have your time. You have the systems that you use. So what is it that you use? Do you use a system that it costs you, like this particular system we're using right now, I'm not sure what it costs, but let's say it costs $240 a year. Well, there's a cost to that. You have your computers that you are housing this product on, right? You have a website where you're housing it on. So you've got all those kind of costs that you have to keep in mind. But again, that would be, I would love to actually talk to you about that and help you come up with that cost of goods line, because it's an intangible, which is very difficult to figure out. But you do have cost of goods if you really think about how it is that you came up to produce that. So once you came up to produce it, you'll have an understanding of what it really costs you to create that course. And obviously then you create your retail, so you make a profit on that based on the work that you did. Again, you can't put all your work into it, because then you'll be totally uncompetitive, because I'm sure you spent many hours putting it together. But we would have to come up with a portion of that and then a profitability where over time you're kind of paid back. So you're kind of like the machine that I can't pay you right now for that $5,000 machine, but we can create a profitability scenario where over time you're going to be really paid back for all of that. I don't know. Hopefully that made sense.
Definitely. Thank you so much for that explanation.
Okay. So if we go back to the equipment here, it was $160 to run your equipment for this particular job. And then you get into your materials, which are t-shirts, ink, film, screens, design, your boxes. You determine how much you used for that particular job, your costs, and then you tell it, and you're told right here that it costs you basically almost $1,200 in materials. And you can use this particular form or a form like this no matter what you're doing, whether you're consulting. You can change, this does not have to be equipment and this does not have to be materials. You can put in how you are pricing out your widgets and your services, and to get an idea. But I really highly suggest you really think about how much time you're spending on whatever it is that you're producing. So we've determined all of our costs. We come down here to company costs, and it costs us about $1,700 to create 1,000 t-shirts. I always like to put in an operations cost, which is just a percentage that takes care of marketing, that takes care of your admin, that takes care of some of your utilities. And in this particular case, I put 5%. That's entirely up to you on what you add in for that extra scenario. Obviously, in this particular thing, you're putting in shipping, and you come out with a total cost of $1,844.92. So that's what it costs your company to produce these t-shirts. So what are you going to charge your customer? We've determined, and I'm sorry, I just wrote over this, but it's a 55% margin. We've determined that's what we need to make in regards to our products going out of our building. So that brought us to a $4,110 cost to the customer, or $4.11 cost per shirt. And on this job, we're going to make $2,265. So this scenario has brought you through from beginning to end of what it's going to cost your company and how much money you're going to actually make as you sell this product. As you sell this product. This is a scenario you really want to do for not only for customers on one-shot deals, but if you have categories that you're selling on an ongoing basis, you really should go through an exercise something like this, so you really make sure your categories are profitable. Were there any questions on this?
So we did get a follow-up from Sue. Just a quick update. She says that currently her cost includes only ads, and time is and expenses, but obviously she does get tripped up. So thank you for the update on that one. Kind of an older question we have from Sharonor is which apps or software programs do you recommend for this type of financial modeling for new businesses?
So I have on my site, I have templates like this. So on my site, I have classes that you can take on how to do your cost of goods. And I have templates like this that you can download and use. I have not used the software system. I've kind of created my own system. Thanks. That you can, but you can also create your own. I would be more than happy if you want to share my email address. I would be more than happy to share some of this stuff with you to get you going, and I can share some videos on like the cost of goods. I don't have an issue sharing some of my videos with you to get you kind of going in the right direction. So if you want to do that, please feel free, Alexandria.
We will definitely be interested in that. Thank you so much.
Because this is hard. This is hard, and it's very hard to do on your own. And I also like to put out there that I have absolutely no problem either having one-on-one meetings with anybody just to get them going in the right direction and having a conversation of what systems may work the best for your particular company. So just hit me with an email. We can chat. So moving on, we're going to. So moving on, once you're finished with the cost of goods exercise, this is where you would put in all your costs. So your materials, your labors, your supplies, if you subcontract, this is where you would put in all your costings. So you have a total cost of goods by month. And this is really where it gets really difficult. So when you're planning your budget, and we don't know how many actual things we're going to sell, we're projecting how many actual things we're going to sell. What we want to do, and doing those exercises will help you, is create a gross margin portfolio so we understand how much margin we're going to bring into our company based on our sales and based on the cost of goods templates that we have created. In this particular company, we're going to bring in a total of 63% in gross margin. On a monthly basis, it has fluctuated a little bit based on how we think we're going to sell. And it's based on the sales income stream, the one we've already looked at, because each of those categories brings in a different margin. So when you put those numbers in and you put in your materials and labor and supplies, or you can change this to be income 1, cost of goods, income 2, cost of goods, income 3, cost of goods. So you're following your income line. That will give you a gross margin down here. So we're going to get into a little bit of gross margin right now, but this just to kind of give you an overview of how you kind of create this part of your budget. So hopefully that makes sense to everybody. Give Alexandria a thumbs up if you're still with me.
I've had a couple people DM me thumbs up, so I think we're good to go.
Okay, because I know this part is the hardest part of the entire budget. So I understand that.
So one quick thing, will you be able to possibly send these exact templates? Because I think it'd be awesome to be able to follow along as participants are watching a replay.
Yeah, I can send you all the templates that I have in this PowerPoint.
I think that would be very appreciated. We got a thumbs up from Sharon Orr.
Okay, awesome. Yeah, I can definitely do that. I'm into sharing. I'm into, let me give you the tools and resources, because every business in the world has a right to be profitable, to be successful, and to be financially healthy. And I am that person that's going to get you there, because I think it's so critical. And that's another reason why I started my site, because for like $20, you can get into and become members and get all this stuff that will help you to be financially healthy, which is the only way you will stay in business. So that's so critical. So there are a couple lines on your budget that are profit lines. One is your gross profit dollars, and the other is your net income. Your gross profit dollars is your top line, which is what we just went over. That's your first line of profit in your company. And it's the most important part. They're all important, but that is the most important part, and it's the one that, absolutely, Sue. It's the most important one because it's the one you have the most control over, honestly, in terms of the profitability of your entire company. So let's look at another formula. So sales minus cost of goods equals gross profit. So for an example, you have income of $50,000, you have cost of goods of $25,000. That means your gross profit is $25,000. It's what's left over after you've paid your cost of goods. And why this is so important is because if you're not making money on the stuff that you're selling, and if you take all the costs all the expenses of what it costs you to sell your product, your materials and your labor, and you stick it in your expense line and you're not making money, you don't know why. If you set up your margin, your budget this way, you do know why. You see that income stream 1 isn't making enough money, or income stream 2 is not making enough profit. You can see it. And if you can see it, you can fix it. And that's why it's really important to have your cost of goods in its own separate section of your budget. We want that cost of goods to be as big, not the cost of goods, the gross profits to be as big as possible. You want your cost of goods to be as low as possible and your profit as big as possible. So now let's look at the expense line. Because now you have this beautiful profit and the expenses are just going to steal all this money. So we want to make sure that we have the right items and we have the right expenses in there. So this is a list of your normal expenses that you'd see on a budget. Some of your expenses are reoccurring. Some of them are a one-time fee, your once a year kind of insurance cost sometimes, and some of them are monthly. I will say this 100 million times. This money comes out of your gross profit. So when you spend expenses, just put your hand in your pocket and take out money and give it to someone, because that's exactly what you're doing. Every time you have to write a check to pay a bill, you just took money out of your pocket, out of your profitability. So in order to have a positive net income, your gross profit must be higher than your expense line. So I'm not going to spend a lot of time on expenses because you know what they are. They're your rent, your advertising, your interest expenses, your utilities. What we're going to talk about now is, okay, what happens? I've done all my expenses. What happens to that net? My second line of profit rather. So your formula is income minus cost of goods minus expenses equals net profit, or gross profit minus expenses equals net profit. Bottom line, it's what's left over after you've spent your cost of goods and after you paid your expenses. So let's look at this line a little bit. And we're going to notice that we have some negatives here. Our first quarter, first 2 months, not so good. And the back half, not good at all. So we've lost some net. So what I'm going to tell you right now is stop. And let's go back and look at your income. Let's go back and look at your cost of goods. And let's review your expenses. Is there any way that we can change that net income line to be a positive? Now, what I don't want you to do is go put numbers in there that make you feel good. You know, if I raise this from 4,000 to 6,000, I lower my cost of goods, so my margin's higher. That works. Well, that works on paper, but I can guarantee you it will not work in your life. And we want this budget to be used for projections and to be able to make financial decisions. And if you're not being realistic with yourself, you're going to do a lot of planning that's going to just set yourself up for failure. And you don't want to do that. But I would say go tweak. So let's say we tweaked and we're still at these numbers. I'm going to say don't worry about it at the moment. As we go through this, the next set of processes, I will explain more. But another thing that you have to realize on this net income line is you cannot make financial decisions for your business based on this one line only. There are another set of numbers that come out of these numbers. Now, there's a couple of different software systems you can use, like QuickBooks, that have P&Ls, balance sheets, and cash flow statements. Now, I'm going to talk to those people that are using QuickBooks at the moment, right now. When you have a net income line on your P&L, that is not a true net income line because you have balance sheet items that come out of your net income. For example, you have loans. If you have a loan from a bank for $5,000 and your monthly payments are $200, that $200 has not come out of that net income line. And here's why. On your balance sheet, your loans show up as your principal. On your P&L, what comes out of that loan is the interest. So let's say $200 is your principal and $50 is your interest. So you write a check for $250 every month. $50 will be on your P&L. $200 will be on your balance sheet. So right on this particular example, only $50 of that is coming out of your expenses onto your net. You still have $200 that are coming out of your checkbook or out of your cash flow. That's on your balance sheet. So the only way in a QuickBooks world that you can see your true net income is if you do a cash flow statement, which takes your P&L and your balance sheet and you puts them together and gives you your true cash. So I want you to keep that in mind as you're doing. Even if you're a QuickBooks user, I always suggest you do a budget on a spreadsheet because it gives you a better look, because their budgeting system isn't that great in QuickBooks. So you can't move things around and you can't see your nets and your cash flow and things like that. So just keep that in mind, QuickBooks users, that there's a separation. Now, And that's why I say you cannot make financial decisions. So let's look at my next sheet, which is the balance sheet items on the spreadsheet. And it's below your net income line on this particular spreadsheet. So here I have your cash in and cash out, which is investments you're making into your, it's equity you're putting into your company and equity that you're taking out of your company. I am not talking about draws. I'm just talking about equity. I'm investing in, I'm paying myself back, my investment. Credit cards, again, is just like a loan. You have your principal payments on your balance sheet. You have your interest on your P&L. Loans we just talked about, investment paybacks if you're owing anybody money, and then you have your draws. Now, I kind of just went over this in terms of the balance sheet, but just it's so incredibly important to remember that principal only shows up on your balance sheet, interest shows up in your P&L, and your equity draw. So if you're an LLC and you're paying yourself, that comes off your balance sheet. It does not show up on your P&L. So that's something really important. And if you're an LLC, you do not take a W-2 paycheck. But now if you're a S Corp, B Corp, and you're set up like that, as an owner, you will take a W-2. So you will show up on the payroll line of your expense sheet. So I hope that makes sense to everybody. So now I'm going to sneak back to the balance sheet again. So we have determined that how much money on the balance sheet side is coming out of your P&L or of your budget. So I've just put your net income up here so you have a better look at it. So let's review these numbers. In January, I lost $30. I have a cash flow. We're going to talk about cash flow in a minute, but I'm going to kind of jump ahead a little bit. I put in a cash flow of $15,000. A cash flow, $15,000 means there's no money that's owed to it. It's pure cash. I lost $30. I took another $375 out based on my balance sheet. So I lost dead net, which is your third line of profitability. I lost $405 that month. But because I have a cash flow, I still have cash. And I'm feeling pretty good about things. Again, as you go through this process, seeing the negatives here and seeing the negatives here, again, I would say, let's go back and look at your budget and see what can we tweak. What can we tweak on the balance sheet type items? So again, you want to tweak realistically. You don't want to tweak to feel good. There's a big difference there.
Could I just stop you real quick? Because I think we have an interesting related question. What advice do you have for first-time business owners paying taxes? Anything to watch out for or anything to expect?
Okay, my disclaimer is I'm not an accountant. So your best bet is to talk to an accountant. However, and especially if you haven't had a meeting with an accountant yet, please do, because they will really give you some great advice in terms of, especially if you're going to use QuickBooks, on how to set your QuickBooks up so it works the best way for you, but also how to set your financials up overall. That's a really good question, and I'm trying to think of how to answer that question. So a first-time business, some things to think about. When you invest into your business and you're paying yourself back, you don't have to pay taxes on what you pay back because you're paying yourself back alone. So keep that in mind and talk to your accountant about that. Make sure that's not just I don't think it's just a New Hampshire thing. I think it's a United States thing, but make sure that it's just not a New Hampshire thing. but I guess I'm going to go with my disclaimer and say, talk to your accountant about taxes. I talk to my accountant about taxes. I try not to know about, not worry too much about them, because it's jargon I've just never been able to master, is the tax jargon. So as a first-time business owner, definitely talk to your accountant about how you should be setting yourself up so you're not paying much in taxes, which you shouldn't as a first-time owner, because your net is, I'm assuming that your net's going to be very, very low and you're not going to be really paying yourself. So I would have to assume that your first 3 years, you're probably not going to be spending a whole lot in taxes.
Definitely. So that being said, actually, I'm glad you brought up the accountant, because we have another question. This entrepreneur says, I currently have a side gig selling baked goods and don't have a lot of net profit or currently a plan to go full time. When, if at all, is a good time to hire an accountant?
So your business, if I'm not mistaken, and don't forget, most accountants will talk to you the first meeting free. So feel free to, I mean, it may be now may be a good time just to take advantage of the fact that they will give you a free consulting service. But depending how much money you're bringing in, and depending how you're doing, I'm assuming you're doing as a solopreneur, which means the income that you make is going to be personal. So you don't have a business income because it's considered as a hobby. The IRS has certain levels that you have to hit before you're considered a business as opposed to a hobby in so many years. And if you're a solopreneur and not an LLC, then that is income that is going to be a personal income tax. So it won't be a business tax. It'll be your personal taxes.
Got it. So just to clarify, when do you cross the threshold from a side hustle, personal income into a business income? Does it have to do with hiring people? And I'm not really sure.
Yeah, it usually has to do with how much money you make, how much net income. Do you make any money on your business? I have businesses that I work with. You know, I have a particular baker I work with. She's got a great little business going on. She's got her own shop, but she doesn't make any money. So the IRS is just about to say, hey, you're really just a hobby. You're not really a business. But she has an employee and she's got a bricks and mortar place. When you're a solopreneur, as long as you're a solopreneur, all your income that you make goes into your personal taxes. So that's a definite accounting question, because I don't believe that they separate that when you're a solopreneur. So I don't think you're considered much of a business as a solopreneur, only because it funnels into your personal life. As an LLC, you're defined. You know, so I'm an LLC. I have my personal world, and I have my Connor Business Resources world with its own EIN number, its own tax ID number, a bank account, and its own taxes. So I think it has a lot to do with net in terms of when the IRS determines you're a business, but I also believe it has to do with how you set your corporation up or your business model up. Again, an accounting question. So that's my disclaimer for all those accounting questions. Ask your accountant. And again, you can probably get a free meeting with them, so it might be well worth your time. So by the time you're done, and we are going to talk about cash flow. I'm not done. I'm not done with talking about numbers yet. But by the time you're done, your budget should look something like this. You have your income here, cost of goods, your expenses, and your balance sheet items, your dead net, and your cash flow. So you're finished, you've looked at it, you've validated, you feel good about it. So now we're going to make sure that the cash flow is flowing properly. Doing budgets is just all about how that that money flows through your system, flows through your business. We want to, and obviously cash is king. It's so true. We want to make sure that it continues to flow. So here's the technical definition of cash flow. Cash flow is the movement of money into or out of a business, project, or financial product. It is usually measured during a specified finite period of time. Measurement of cash flow can be used for calculating other parameters that give information on a company's value and situation. Need to remember that being profitable does not necessarily mean being liquid. A company can fail because of a shortage of cash, even while being profitable. I have seen it happen. So just because your net income is coming in, if you don't have cash flow to support that, unless that net income is so huge, you're not in a good, healthy state. Our cash needs to be liquid. So what does that mean? It's easy math. It's revenues minus cash in minus the expense cash out, and cash flow is what's left over. So that's when I talk about that dead net. That is the dead net that we hit in your budget is the profit that your company is bringing in that particular month, which I'll show you again in a minute. I'll show you we'll go back to that spreadsheet. I think it's important to notate that there's other ways of bringing cash into your business besides revenues and gross profit. If you extend your terms with your vendors, so you keep your money longer. So instead of paying net 30, you're paying net 45, net 60. You can use that cash. You're holding on to it longer. If you shorten your terms with your customers, so maybe you're giving them net 35 terms. Can we give them net 30? Can we give them net 15? And you're bringing that money in faster. And then we have loans, lines of credit, those kind of things that will also bring money in and help out with your cash flow. Now, if you have an online business and you're getting money immediately, perfect. If you can get money immediately into your business, that is a fantastic model to follow. But not all of us are that lucky. So there's other ways of bringing it in. So I want to go back to cash flow to make sure that you really have a good understanding of this. Again, we started with $15,000. We understand what our net income is, and we understand with our total dead net, basically our net minus all of our balance sheet items. And here lies the cash flow. We have a really good run going on, despite the fact that we're losing money here, here, and here. But look at this. I still have almost $8,500 in cash flow. And I'm adding and contributing to that cash flow between May and September. I'm adding in because I have a healthy net. So now I'm starting my back half off with $16,000 worth of cash flow. And unfortunately, I'm not having a very good fourth quarter. So I've lost some money, but I'm ending the year at $8,300, which is good. You've got some liquid. And what you also have is $8,300 that's going to help you in the first quarter, because we already know January through March is not good for us. It's going to help us in that first quarter of the following year. What I like people to do is not just 12 months, stagnant. Okay, it's December. Let's start that budgeting process over again. I like a rolling 12 months because you always want to look out 3 to 6 months. Because we know in January, let's pretend this is 2021, and we know in January that in October, we're not going to be doing so well. We're going to be losing some money. I have from January all the way to October to fix that problem. I have time. I don't care how big your business is or how small your business is. For you to fix a problem in a month, which is what we would have to do to take care of February, you can't do it. It's like turning the Titanic. Even if you have a small business, if you need to increase your profitability, you also have to increase your sales in order for it to make a difference on the bottom. If you do your budgets, if you do your projections, and you're always looking at them on a monthly basis, you have time to react. And that is the most valuable thing that you can have for your business. It's cash flow and time to react to a trend that's not going in the way that you want it to go. So I hope that this has not been really overwhelming. It's a lot of stuff. I totally understand that. And what makes it really difficult is, depending on the kind of business you are, my answer may be a little different. So it's kind of hard to, when you're talking to so many businesses, to give you a good overview of what cost of goods should look like, what dead net should look like, what profitability should look like. But I hope it has given you an idea of how to attack this project for your business. So if there's any more questions, I'd be more than happy to answer them.
Awesome. Thank you so much for all those demonstrations. I definitely appreciate seeing some hands-on data and some very usable templates. So I'm sure that I speak for everyone when I say those are going to turn out to be extremely valuable, and we're really appreciative for them. I do want to be a little bit cognizant of time. So I won't want to keep you too long. For everybody watching, if you'd like to see a recording, we will have it posted on our Facebook page. So luckily, anyone who maybe wasn't able to make it the first time, hopefully you're viewing it as a recording. That being said, I want to try to cover some of our different participants' stories, sort of. So I know for a fact that food and food products have some of the lowest margins of any industry.
Yep.
And I was just wondering if maybe you had any kind of general advice, because I know you've obviously done plenty of consulting. I was just wondering if you've had any specific anecdotes that you think might be useful, or advice, or anything of that nature.
Now, when you say food, are you talking about restaurants? Are you talking about food manufacturing? What are you referring to in terms of the industries in the food world?
I don't think we have too many entrepreneurs who have a brick and mortar restaurant. Most of them have, like we talked about earlier, most of them are baked goods. We have one entrepreneur who bottles hot sauce and has a catering business sort of separate, but that's kind of more what I'm thinking, less of a restaurant situation and more of a prepackaged baked goods. Yeah.
Okay. Yep. So I love the food industry. My favorite people to coach are people in the food industry, because it's so dynamic. So for those of you that are manufacturing or baking, the template that I used in this particular presentation, which if you send me an email, I will share with you, is the template that I use when I'm trying to figure out the cost of goods for bakeries, for food manufacturers. There's an industry standard for bakers, and this is kind of a brick and mortar baker, but there is an industry standard for a baker, and it's usually 50% or less. Up to 50% is a great margin to have. One thing, depending on the industry that you're in, there are really some great industry organizations that will help tell you what the industry averages for margins. So you know that kind of where you are, because I'm sure the biggest problem you have is, what do I charge for my stuff? And they will help you determine basically what, on average, a margin is for that particular industry. Another way that you really need to think about it is, how much margin do I need to make in order to be successful, in order to be able to pay my bills and stay competitive? So the exercise, that first spreadsheet that I showed you, where it was the revenue overview, and you put in your income streams and determined your profitability by income stream, that's a great place to start, so you have an understanding of where you stand today, of your profitability. So I guess if I were to do this in order, I would say to you, create your cost of goods by income stream, whether it be your hot sauce. Your income stream would be you have hot sauce, and you probably have different versions of the hot sauce, but you have different sizes of hot sauce. So you might have your 8 ounce and your 16 ounce and your 12 ounce and your jug. And it could have all different flavor profiles in them. Now, I don't know if you have a different cost for hot versus mild. Let's say you don't, then you can go by size. If there's a huge difference between hot versus mild, then I think I would do costing on hot versus mild and see where you came in. For catering, I would have to understand when you did your pricing. I would assume that you did it per catering gig that you had. But what you need to really think about is, what is your base? What does it cost you just to turn the lights on in the morning? And that will give you a base, an overhead, in terms of you cannot go any lower than X amount per plate. You may say your overhead, I'm just going to make up numbers, is $5. So you can't go any lower than $5 per plate. And then the rest of that money, or per person, is your profitability, your cost of goods, and that kind of thing. So your $5 per person, by the time you're done, it may be $25 per person in order to be profitable. But $5 is what it costs just to turn your lights on. So every single industry is very different in terms of how you have to go after your cost of goods and your profitability. So hopefully I made sense in all that, and hopefully it answered some of your questions.
Yeah, certainly. That's some really good advice. Thank you. I did want to, I want to point out something that sort of just occurred to me. The difference between selling baked perishable goods and one thing that a lot of our entrepreneurs do, which is, handmade products. So we have an entrepreneur who manufactures soy candles that are all natural, that have a surprise crystal inside. We have plenty of entrepreneurs who have similar businesses. I apologize. I think my internet is a little bit unstable.
That's okay.
But there's a difference between that and perishable goods, because you can't necessarily stock up on perishable goods like you would with just, you could manufacture as many, leather goods items as you want, and
right,
you'd be able to sell them later on. So does that affect anything with the margins or cash flow?
It does. So there's a couple of different ways to look at that. I will tell you, anything in your warehouse that's raw materials or finished product is your cash flow. It's just sitting in there waiting to be sold. I do understand that you do need to have some stuff in your warehouse to be able to sell, especially if you're an online company. You get an order, you need to be able to fill it, and you can't, you don't want to give them a lead time of 3 weeks. So I understand that needs to be some. But it is your cash flow. I also understand that if you buy for raw materials, if you buy in bulk, you get a lower price. So there's a lot of things you need to think about. I would say, what you want to determine, if you're a manufacturer that does create products, candles or belts or whatever, you want to understand what kind of turn you want in your warehouse. And I know your warehouse could be a back room. You want to have a min and a max. You'll always have a minimum of 3 on the shelf and a max of 6 on the shelf. So you know when to go back to building. What you don't want to have is to have so much inventory that you're cash strapped because it's all sitting back there. And depending on what the product is, even if it has a long shelf life, you may put yourself in a particular problem of overextending the shelf life or the freshness or even the look. I mean, some of our stuff you make, I'm sure, is trend right and trend specific. You could I'm not a trendy person, so I don't even know what colors are right now, but say it's pastels and you have a whole back room of pastels. The next thing you know, it gets into greens and blacks and grays, but you have pink. So you put yourself into a bad situation because you have the wrong trend item back there. So I would be really careful in terms of how much production that you're putting in the back room, especially. Another reason why a budget's really important is because once you get one that you're comfortable with, it'll tell you how much to produce. So for example, if you're going to do $4,000 in a month and you're selling candles, and that 4,000 equates to 100 candles, well, I know I have to do at least 100 candles just to make my number. But do I have to have all those 100 made at once? Or can I gradually produce throughout a week, throughout the month to get to that particular number?
Definitely.
So I tend to ramble. I get very excited about financials, so I tend to ramble, and hopefully I didn't get off base.
No, don't apologize at all. The more information we have, the better, for sure. I wanted to harken back a little bit to the title, which is probably up there somewhere. I'm not sure where. But I wanted to harken back to this workshop, which is how to keep more money in your business. So I was wondering if you ever see examples of just money being wasted, things that you don't need, things that could be replaced with cheaper options. Do you ever see that? And if so, what are those costs?
I see that, yes. As a business coach, we have to give a lot of bad news. And we have to really hold people accountable. And as difficult it is, because a lot of times, it's your baby, it's your business. You want to make sure that you're taking care of it well and that you're paying attention to it. But when you're also the technician, meaning you're the one producing, things get out of control sometimes because you're just one person, and it happens. And that's why budgeting is so important, because it makes you really realize, what I said, I was only going to spend $100 on this particular line. I just spent $200. What did I do? And so it holds you accountable. But yeah, I have been able to, honestly, when I say to a business, I can come in and I can save you money right off the top. I can save you significant amount of money right off the top. And the way I do that is we look at your cost of goods and we take out all the fat. We look at your expenses and take out things that you definitely don't need. Or we find different avenues for that particular line. We look at your payroll to make sure that if you do have a staff, you're using it wisely. It's very easy. The first thing you do is look at your insurance line. When was the last time you put your insurance out to bid? I do that first, and I always save a lot of money. Now I'm a hero. It's wonderful. But if you look at your expenses and really are honest with yourself in terms of, do I need to spend that money on that particular item? Chances are you can lower that by a particular percentage. It's just about paying attention.
Sorry, it's taking a little bit longer than expected. There I am. Okay, perfect. So I only want to ask you a couple more questions.
Okay.
Let's see. And by the way, guys, if you're watching right now and you have a burning question for Anne, please send it into the Street Entrepreneurs inbox. You guys know the drill. Here's an interesting one. How do I know if it's too early to scale? What's the first thing you should take care of financially when trying to scale or relocate? So it's kind of a three-parter. And should you adjust your revenue goals or try to cut back on certain costs while you're in the process of scaling? I don't know if that's necessarily, that's kind of a lot of questions, but yeah. Well, what advice do you have?
So when you're scaling for growth, okay, so I'm going to tell you another great tool for your toolbox is a strategic plan. And a strategic plan is all about scaling for growth and how to be prepared for it and to be ready for it. So that is a wonderful tool to have as you're planning. So as you're scaling, what I would do, first off, is I would do like a 3-year plan and really understand, when you talk about scaling, what does that really mean? What does that growth trend look like? How quickly is that growth going to go? What is your expense line in terms of, now we're talking about increasing production or increasing your space? You just said you wanted to move. What does that look like? How quickly do I need it? At what point do I need it? Can I scale my sales high enough so by the time I'm ready to do it, I am able to be self-sustainable and take care of it myself, or do I need to go out and get a loan? So it's really about the planning process. And I would strategically plan that over not knowing your timeline, I would strategically try to plan that over years. Well, I won't say years, not months, but over a considerable amount of months. Again, not knowing the details in terms of where you are today, what do your sales look like, what is it that you're selling, where is it that you're going, how many, all those kind of questions I'd ask if we were doing a strategic plan. I think I would just tell you to do a rolling months of budgeting of where is it that you want to end up, what's it going to cost you to get there, and how do I create that financial strategy to propel myself so I can get there. Again, I hope that made sense.
Yeah, this is just another example of some great advice. I think it's about time to wrap it up. And I wanted to ask you a final question on behalf of all of our consultants and aspiring consultants. You clearly know a thing or two about consulting. What is perhaps the hardest lesson you had to learn when you were going about trying to go on your own and have your own consulting firm?
My background helped me in many ways and didn't help me in many ways. So I was a retail buyer for 25 years is what I did for my main career. And I was a retail buyer for one of the biggest retailers in the world with a budget of $600 million. It was just it was huge what I did there. And it made me it made me more of a demanding person, because that's kind of how you had to. I feel like I'm in a therapy session right now, so I'm going to tell you all my warts. But that's kind of how you had to be as a buyer for any kind of retailer. You have to be very strong. You have to be very demanding. You have to make sure that your negotiations are strong, and you don't have to relent a lot of times. Usually you ask for something, you got something. You can't do that as a consultant, which I found out because I kind of came into the consulting world with that same attitude, because I had that attitude for 25 years. So the hardest thing I had to learn was how to be humble and how to be a resource and how to be a support, because I never had to be a support. I had people support me, but in my career, I never had to be that support because I was the driver. I drove the sales. I drove the negotiations. I made things happen. I got things done. But as a consultant, we're here to support each other. We're here to support our clients and our customers, and we're here to be their resource. And I had to really learn how to be humble, I never asked for a sale. I never asked someone to be my client, because it's a big decision to hire a business coach. So I was always there for them as a support system. So we would have, as I got my clients, we'd have many conversations, and I would say, well, together we can work on whatever it is we're going to work on, but we're going to be a team. It's going to be we, not an I and a me. We're going to be a team. We're going to get through all the hardships together. We're going to be partners, and we're going to create this beautiful dream of yours into a company. So I had to really learn how to work more of a partnership as opposed to a dictatorship, I guess. And that was the biggest lesson I had to learn.
That is so interesting. Everyone who's seen a workshop hosted by Juliana knows that she has talked a lot about working in politics and working in what's obviously a very, very cutthroat, high-stress environment, and how over time, she's kind of witnessed having to adapt in different environments and different industries, and particularly when you're shifting from managing completely different kinds of people, frankly. I am obviously not a kind of person who would go into politics because it's too cutthroat for me. But nevertheless, it's all about adapting, and I think having open communication whether it be with your employees or with your clients. And I think that's a lesson that a lot of people could, could apply to a lot of their business aspects in their life.
Yep.
So I think that is our final question. Are there any closing remarks from you, Anne?
No, I mean, this was fun. This was a lot of fun. I thank you for asking me to be part of this, and I would love to do it again if there's an opportunity. Being in business and being a consultant, depending on what kind of consultant you are, is a tough job, especially now with this economy. It's a tough economy. I don't have a whole lot of clients right now just because I'm running another company at the moment, but I lost 2 clients based on the pandemic, just based on the fact of how this economy is right now. So what I would say is, don't lose hope. Just keep doing those great things. Just keep helping those businesses and those clients and those customers that you have, because karma in the consulting world gives back to you. You put out, you get back. So I would just say, just keep on doing the good work that you're doing, and you will be successful.
That is super encouraging. I think that's an awesome note to end on. Anne, thank you so much for sharing all of your valuable resources and advice. And for everyone watching, I will make sure to get these templates to you, share the links, share Anne's email as she's comfortable with. And definitely thank you guys for tuning in. Thank you for commenting. We have plenty more awesome workshops left in the year. I'm going to say goodbye for now, and we hope to see you at the next one. Thank you, Anne, again. Bye, everyone.
Bye-bye.